The market does not care how clever you are. It does not care about your fundamental research. It does not care about your charts, your theories, or the intricate logic you constructed in the silence of your study. The market cares about action. It cares only about the price and the volume. It cares about the relentless testimony of the tape. And if you cannot cut a position the instant the tape whispers doubt, you will not survive long enough to capitalize on the certainty of the big move. The novice uses a stop-loss as a magical safety net. He uses it as a religious promise that his loss will not exceed 3 points. This is folly. The professional does not wait for that arbitrary line to be struck. He uses the stop-loss only as a final, absolute mechanism. His true protective measure is far more precise. It is surgical. It is based on the market's own immediate confession that the trade, the core idea, is fundamentally wrong. This confession is what I term the rule of unexplained weakness. It is the silent, damning testimony that your position is dead money, or worse, that it is poised for a violent collapse. You must learn to recognize this weakness, or you will be washed out before you ever master the game. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. The most painful market lessons, like ignoring that rule of unexplained weakness, are precisely why Jesse Livermore amassed and subsequently lost fortunes. His great wealth was truly earned through the steep penalties paid for delayed realization. This rigorous schooling of an operator was immortalized in 1923 when Edwin Lefebvre captured his strategies and setbacks in Reminiscences of a Stock Operator. It is perhaps the closest one can come to entering the high-stakes mental training ground of the man known as Larry Livingston, absorbing decades of experience without suffering the real-world financial injury. Yet to properly translate this powerful record for the contemporary trader, the essential Max Davidson Annotated edition is required, bridging the gap between the Wall Street of 1923 and the markets we navigate today. A link to this essential edition is provided in the description below. We must first understand that the market never hides its intentions. It signals everything. Your job is not to argue with the price. Your job is to listen with mechanical, detached objectivity. When you enter a speculation, you must have a reason, a point, a thesis. Unexplained weakness is what happens when the market utterly refuses to acknowledge that thesis. It is the moment when the expected buyers or sellers simply do not arrive. This is the anatomy of failure. Listen for these signals. 1. The refusal to follow through. You buy a stock because it executes a textbook signal. Perhaps it crosses an old resistance level. It breaks out on good volume. The signal is undeniable. You enter the position. You expect the stock to extend the move immediately. It should run. It should solidify the new territory. But it stalls. The stock hits its breakout point, say $70, and then instead of moving sharply to $71, it lingers. It backs off to $69.75. It revisits the old barrier. It refuses to follow through. This refusal is the first sign of terminal weakness. It suggests the momentum buyers, the eager crowd that should be piling in behind the signal, have failed to show up. The breakout was a lie, a feint, a trap. If the market gives you a clear green light and then immediately slams the brakes, the light was corrupted. This refusal is the market's immediate rejection of your thesis, no matter how sound the chart appeared. Do not wait for it to trickle back and hit your stop at $68. You cut it immediately at $69.50. Why? Because the reason you entered the trade, the expectation of momentum, is now invalidated. The trade is showing sickness the moment it disappoints. Get out clean. Take the shilling loss. The cost of admission was higher than the value of the ride. 2. The deceleration of momentum. You purchase a stock and it is behaving beautifully. It is running swiftly. Imagine you bought it at $50. In 2 sessions it has moved to $55. This is healthy. This is conviction. Now observe the type closely, and if that same stock now spends the next 4 trading days struggling desperately to climb from $55 to $55.50, the trade is finished. The buying pressure has evaporated. The energy that defined the speculation is gone. It has decelerated. The professional speculator demands efficiency. I demand speed. The market moves fast when the conviction is real. It moves fast when the big houses are accumulating. When the stock stalls, the buying power has been absorbed. The momentum is lost. It is showing unexplained weakness in the face of its own prior success. Do not trust a trade that slows down to a crawl after showing you how fast it can run. A position that cannot move forward decisively, swiftly, and easily is preparing to move backward violently. The energy has been bled out. The market has gone soft. Exit the position. You must recognize that the deceleration itself is a massive signal of reversal. You are not waiting for the price to drop. You are reacting to the speed of the advance being compromised. 3. Failure on the path of least resistance. When I enter a long position, I am making a simple bet. I am betting that the path of least resistance for that price is upward. That is the fundamental premise of the trade. The reverse is true for a short sale. When a stock begins to aggressively test recent lows, levels that should have acted as quick support, the path of least resistance has shifted. If the stock should have bounced cleanly off of $40, but instead it lingers at $40.05, testing $40 repeatedly, the floor is weak. If it attempts an advance and then immediately retreats to retest that weak floor, the path is no longer easy. The resistance is coming from below, which is deadly for a long trade. The market is fighting you. It is fighting your primary directional bet. The path of least resistance is now demonstrably against your position. Do not wait for the stop to be hit. Do not cling to the hope that the floor will hold for the 5th time. React to the change in the dynamic. The struggle itself is the signal. When the market starts fighting its way back to the places it should have easily absorbed, your capital is in danger. Unexplained weakness means the trade is becoming difficult, and difficult trades are losing trades. 4. The price of time, dead money. Time is capital. Time is the speculator's most precious, non-renewable asset. When I initiate a position, I do so with a clear expectation of timing. I expect the move to begin within 3 to 5 sessions. If the signal is real, the movement should commence promptly. If you enter a stock and it languishes motionless for 2 full weeks, trading in a narrow channel, refusing to make a decisive move up or down, it is tying up your funds. It is consuming your time. This is dead money. A position that won't move is showing a profound lack of sponsorship. No one cares. The big money has not chosen this moment to act. This is not a technical failure yet, perhaps, but it is a monumental strategic failure. I cannot afford to have 20% of my capital sitting dormant in a stock that goes nowhere. That capital should be deployed elsewhere, in a stock that is moving or held back waiting for the undeniable setup. The cost of holding dead money is the cost of missed opportunity elsewhere. That cost over time will bankrupt you just as surely as an outright loss. Cut it. Exit the position not because it has moved against you, but because it has refused to move at all. Free your capital, free your mind. Be ruthless with idle funds. There is our 5. Relative weakness in a strong general market. This rule is a profound indicator of deep structural rot in your position. When the broad indices, the Dow Jones averages or the relevant sector averages, are advancing strongly, your particular position must at the very least be advancing with them. Ideally, if you have picked the right stock, it should be advancing even more strongly. It should be leading the pack. But observe the tape when the general market is booming. The S&P is up 2 points. The news is positive. The entire sector is running. and your stock is merely treading water. Or worse, it is showing a slight, inexplicable decline. This is significant, unexplained relative weakness. It is refusing to join the party. When all external conditions are favorable, when the wind is at its back and your stock is still struggling to maintain altitude, it means the major players are abandoning the ship, or they are unwilling to touch it. This weakness precedes catastrophe. When the broader market finally falters, which it always does, your weak stock will not fall with the others. It will plummet. It will lead the general decline. You must cut a stock that shows relative weakness immediately. It is betraying you during the time of universal strength. It is showing the sickness that only the biggest interests can perceive. Trust the weakness over your own conviction. 6. The unwanted retreat, the 50% rule. Sometimes you enter a position based on a sharp, convincing move upward. The stock jumps from $100 to $105 in a session. You buy into the strength, you buy the move. The question then becomes, how much of that movement can the stock surrender before the original demand is proven transient? If you buy on a move and the stock immediately retreats 50% of the movement that attracted you, that is, it falls from $105 back down to $102.50, it is signaling deep trouble. That 50% retrace tells you that the buyers who drove the price up were weak hands. They sold out immediately. It signals that the move was based on transient enthusiasm, not institutional conviction. The smart money did not support the advance. $102.50 is not an arbitrary number. It is the line between valid consolidation, a healthy pause before the next leg up, and outright failure. If it gives up half of the impetus that compelled you to act, the impetus is gone. Do not wait for a full reversal. Do not wait for $100. The moment it gives up 50% of the recent advance, the trade has confessed its internal weakness. Cut it. Protect the remaining capital by acting on this precise mathematical betrayal. 7. The small loss principle, the cost of doing business. The entire purpose of recognizing unexplained weakness, of applying mechanical discipline, is to take the loss while it is still small enough to be inconsequential. A small loss is not a mistake. It is a research expense. It is the cost of finding out that the market was not ready, or that your analysis, while sound, was mistimed. You must never allow a manageable small loss to escalate into a genuine crisis. The moment a loss threatens your ability to sleep soundly at night, the moment it causes you to worry or neglect other market opportunities, it has grown too large. It has moved from being a business expense to a psychological threat. The speculators who fail are the ones who refuse to admit error early. They let a manageable $500 loss become a crushing $5,000 drawdown because they substitute hope for discipline. When unexplained weakness appears, when the trade starts to look sick, you must immediately treat the position like a laboratory experiment that failed. Close the ledger. Pay the expense. The only way to guarantee longevity in this business is to maintain the integrity of your capital. And that integrity is maintained by making losses routine, predictable, and small. 8. Do not average down into sickness. This is the greatest catastrophe of ego. When a position is showing unexplained weakness, when it is languishing, retreating, or refusing to follow through, the amateur often says, "It's cheaper now. I will buy more and lower my average cost." This is the most dangerous form of hope. You are compounding your mistake. You are taking a single error in judgment and multiplying its size and its potential for ruin. Averaging down means you are betting more on a setup that the market has already loudly declared to be unsound. You are not buying a bargain. You are buying sickness. When the market tells you through the tape that you are wrong and you double down, you are betting against the highest authority with twice the size. Averaging down is fundamentally based on the emotional refusal to accept error. It is a desperate attempt to manipulate your average price so you can eventually get out at break even. The goal is not to break even. The goal is to make money. If a stock is moving against you, the only sensible professional action is to reduce the position or eliminate it entirely. You never add to a losing position. The rule is this: only add to strength. Only compound your winners. Never feed your losers. The first hint of unexplained weakness must trigger the thought, reduce, not increase. 9. The emotional betrayal of hope. Once your trade enters the territory of unexplained weakness, the only reason you have left to hold that position is hope. Hope is the single most expensive word in the speculator's vocabulary. Hope is the enemy of discipline. It paralyzes action. It clouds judgment. When the price is refusing to extend, when volume is drying up, when the move has stalled for days, the speculator who holds on is substituting emotion for data. He hopes the market will turn around just time to prove he was right. The market does not care about your emotional validation. It will take your money and laugh at your vanity. Trading decisions must be mechanical. They must be rooted purely in observable price action, in volume, and in the movement of the averages. The moment you realize you are clinging to a stock simply because you want it to go up, you have already lost. You must cut the line immediately. The speculation becomes tainted the instant the decision is driven by the emotional desire to escape loss, rather than the mechanical pursuit of profit. If you find yourself praying for a move, you have forgotten the rules. Praying has no place on the floor of the exchange. Only action has currency. 10. The necessity of the clean slate. Cutting a losing position, especially one showing unexplained weakness, is not just about saving money. It is about saving your mind. You cannot make sound decisions when your capital is tied up in a position that is draining your mental reserves. That dead money poisons your perspective. Holding on to a losing, struggling stock creates prejudice. It creates bias. You desperately search for reasons why the stock should go up rather than objectively observing why it is not going up. This lack of clarity is the most dangerous state for a speculator. Cutting the position clears the board. It restores your mental liquidity. It frees your mind to view the entire market without the immense prejudice of a vested interest. The most valuable asset you have is clarity. Unexplained weakness demands immediate mechanical action so you can regain that clarity. You must be nimble. You must be unburdened. The moment you are clean, you can wait for the next, undeniable, obvious opportunity, the one that moves precisely as expected, without hesitation or apology. You must master the discipline of cutting losses with the same mechanical indifference you use to lock in profits. There is no room for pride. There is no room for ego. The market is not there to validate your ego. It is there to enrich those who obey its simple, cruel signals. Surviving the inevitable small loss is the only true preparation for seizing the inevitable massive win. You cannot participate in the big moves if your capital is depleted and your mind is distracted by a position showing weakness. Discipline dictates survival. Obey the tape. Listen to the confession of the price. If the weakness is unexplained, the position is dead. Act now.